Okay, let's kick things off with a pretty startling number. The decision intelligence market. It's projected to just skyrocket. We're talking roughly $15 billion in 2024, jumping to over $88 billion by 2034.
Wow, yeah, that's massive growth.
Exactly. It's an explosion, really. And right there, aiming to grab a piece of that, is BigBear.ai, ticker BBAI. Their mission sounds pretty ambitious. Deliver clarity for the world's most complex decisions, for clients in really high-stakes fields. So the big question for this deep dive, the one we really want to unpack is, okay, they're in this booming sector, but what can we actually pull out from all these reports to understand their real shot at long-term success?
Precisely. Today, we're putting BigBear.ai Holdings, Inc. under the microscope. We've gone through quite a stack of sources, financial filings, market data, analyst reports, you name it.
Yeah.
The goal is to give you the essential picture, their operations, their financial situation, and where they might be headed in this fast-moving AI world.
And just so you know, if you want to check out the sources yourself, we've listed everything down in the description. Our mission today, pretty simple, really. Cut through the noise.
Yeah, there's a lot of it.
Give you a clear, concise view of BBAI's business, the challenges they're up against, and what factors are really going to make or break their future. And honestly, we found some pretty interesting stuff about their strategy and some recent events.
Definitely. Okay, so let's start with the basics, understanding the business. BigBear.ai, they're based in McLean, Virginia, and they specialize in these AI-powered decision intelligence solutions.
Right. Yeah.
Their main targets, think national security, defense, supply chain management, and increasingly digital identity. They went public back in December 2021 through a SPAC deal.
Okay, and that SPAC route sometimes brings its own baggage, but we'll get to that. A really big move for them recently was buying Pangiam, wasn't it? Back in February 2024.
Yeah, that was significant. It really beefed up their vision AI and digital identity toolkit.
And then almost immediately after, January this year, they brought in Kevin McAleenan as the new CEO. He used to run Pangiam, and he's got serious government cred, former head of DHS, Customs and Border Protection.
That appointment really signals a doubling down, doesn't it, on national security and digital identity. It looks like they're aiming squarely at those potentially stable, long-term government contracts.
Makes sense.
That seems to be the core strategy. Get their AI into these really complex, high-stakes, mission-critical environments.
Okay, so what exactly are they selling? What are these AI-powered solutions?
Well, it's quite a broad portfolio. You've got predictive analytics, machine learning, computer vision, modeling, and simulation. It covers a lot of ground.
Yeah.
Some key names to know: ProModel Solution Suite, that's simulation software. Actually been around over 30 years, used a lot in academia. Then there's Dominate for supply chain analysis, Arcasys for national security, situational awareness. And of course, the Pangiam stuff, their TrueFace, facial recognition, threat detection, Veriscan, biometrics. Plus, a really important piece seems to be Conductor OS.
Conductor OS? What's that do?
Think of it as the orchestrator. It's supposed to link up all their different AI, data streams, sensors, make them work together. It's particularly relevant for things like the Army's Project Linchpin, managing drone swarms and that sort of thing.
Okay.
They also have Observe for analyzing public info, and Toy and Spacecrest for cybersecurity. So it's a lot.
It really is a diverse set of tools,
Yeah.
which sounds good on paper, but integrating all that must be a challenge, right?
Yeah.
Making sure ProModel talks to Pangiam Tech, and it all feeds into Conductor OS smoothly.
That's a critical point, yeah. The breadth is an opportunity, but also a huge integration challenge. Conductor OS seems to be their answer, their attempt to create that interoperability. If they pull it off, it could be a real differentiator.
So how does this translate into money? Where's the revenue coming from, primarily? Who are the big customers?
Mostly, it's contracts for the solutions themselves, plus professional services wrapped around them. Key markets. Heavily weighted towards government and defense, DoD, DHS, the intelligence community.
Okay.
But they also target manufacturing, warehousing, healthcare, even academia, like we mentioned with ProModel.
And I remember reading the revenue can be pretty uneven, especially the government side. You called it lumpy.
Exactly. Lumpy is the word they use. It's tied to winning contracts, hitting milestones, options being exercised. It's not a steady stream. Makes forecasting tricky.
Yeah, I bet.
And their backlog, as of March 31st, 2025, it was $385 million, which sounds like a lot, but it's actually down from $418.3 million at the end of 2024.
A decline. That's noteworthy.
It is.
Yeah.
It raises questions. Are they burning through contracts faster than winning new ones? Is it a temporary dip or something more? Especially since it was reported even higher, like $480 million at the end of Q4 2024 before restatements.
Definitely something to watch. And the reliance on the U.S. federal government, that's a big concentration risk, right? Didn't they get hit when Virgin Orbit went bankrupt?
They did, yeah. That impacted their 2023 revenue. It highlights the risk when one customer segment is so dominant.
Okay, so scale-wise, what are we looking at? Market cap, employees.
Market cap's been bouncing around roughly $888 million to maybe $1.04 billion as of May 2025. Their 2025 revenue guidance is $160 million to $180 million, and they had 730 employees end of last year.
And their big pitch, their value proposition.
It's that clarity for the world's most complex decisions. They specialize in those really tricky, distributed, mission-focused environments.
And they have had some recent wins to point to.
Oh, yeah. They're modernizing the DoD Joint Staff's Orion platform. They're working with Austal USA on AI for building submarines. They're in Project Linchpin with the Army, using Conductor OS for those drone swarms, and more work with DHS and digital identity.
So the tech is getting traction in key areas.
It seems so, but the core challenge remains. Shifting from these, project-by-project deals to stable, recurring revenue, that's the key to actually becoming profitable, given their history of net losses.
Okay, good overview of the business. Let's shift gears now and look at the people running the show, the management team.
Right. Big changes here recently. Obviously, Kevin McAleenan stepping in as CEO in January 2025 is the headline. His government background. Acting DHS Secretary, CBP Commissioner, that's huge potential leverage for winning contracts.
Oh, what's the stake like? Compensation?
Total comp around $1.61 million. His share ownership is actually pretty small right now, like 0.085%.
Okay. Who else is key? CTO.
CFO, Theodore Tanner Jr., the CTO. Loads of experience, 30-plus years. IBM, Watson Health, Apple, Microsoft, holds AI patents. His comp is about $1.71 million. Then Julie Peffer, the CFO. Background includes Media Analytics, AWS, Raytheon, Texas Instruments. Her comp is just under $1 million, around $967,000.
And didn't the reports mention she sold some shares recently?
Yes, that's right. Sold 20,000 shares on May 8th, 2025. Which, the timing always raises eyebrows.
Always does. Any other execs we should know?
Carl Napolitano is COO, came over from ProModel. Carolyn Blankenship is general counsel, lots of legal experience. And Sean Ricker, the chief accounting officer, ex-Lockheed Martin. He also sold shares multiple times in May 2025.
Wow, okay. Multiple execs selling in May. And the overall team tenure is pretty short.
Yeah, average is only about 2.3 years, reflects all the recent shuffles. So McAleenan brings the government connections, which is a clear asset. But he's also inheriting, let's call it a governance situation.
That situation, right. The reports mentioned restatements, material weaknesses.
Exactly. So his ability to not just win contracts, but also clean up the governance, rebuild trust, that's absolutely critical. And his small initial shareholding is, well, it's something investors will watch.
Okay, what about the board? Who's overseeing management?
The chair is Peter Canito. He's also CEO of Redwire and an operating partner at AE Industrial Partners, AEIP.
AEIP. They seem connected here.
Very. Kirk Knert and Jeffrey Hart on the board are also tied to AEIP. Other directors include Sean Battle, co-founder of PCI, and Pamela Brayton, CEO of Griffin Technologies. Average board tenure is a bit longer, 3.4 years.
And the board committees. Standard stuff.
Pretty standard. Audit, compensation, nominating, and corporate governance. But there's scrutiny here, too.
Because the financial restatements and that material weakness happened on their watch.
Precisely. Questions about oversight, questions about the independence of those AEIP-linked members. It's all come up. They did amend the Audit Priority Charter in March 2025, which looks like a response.
But the proof will be in the pudding, right? Can they actually prevent future problems and fix the current ones?
That's the million-dollar question, or maybe the billion-dollar question, given the market cap.
Okay, let's dive into the financials now. Chapter 3, Financial Health. What does the history tell us? Say FY22 through Q1 2025.
Well, revenue growth has been modest. FY22 was $155 million. FY23 basically flat at $155.2 million. Then a slight bump in FY24 to $158.2 million. Q1 2025 saw $34.8 million, which was up year over year, but it missed expectations.
And they lowered guidance for this year too, didn't they?
They did. Dropped it from around $200 million down to $160, $180 million for 2025. So growth is tepid.
Okay. What about actually making money on that revenue? Gross profit.
Gross margins have bounced around 28% in FY22 and FY24, a bit lower in FY23. Q4 2024 actually looks strong at 37.4%, but then Q1 2025 dipped back to 21.3%. So some inconsistency there.
But the bottom line, operating loss, net loss, that seemed like the real story in the report.
Yeah, that's where it gets tough. Consistent operating losses. FY24 was a huge loss, nearly $296 million, but that was heavily impacted by a massive goodwill impairment charge.
Writing down the value of past acquisitions, basically.
Exactly, like Pangiam. Plus derivative losses. Q1 2025's operating loss was smaller, around $21 million, mainly because there wasn't another impairment charge. Still a loss. Net losses follow suit huge in FY24, 295.5 M, and $62 million loss in Q1 2025, which was worse than expected on an adjusted per-share basis.
Ouch. An adjusted EBITDA. Sometimes companies point to that as a better measure.
Still negative. Q1 2025 was negative $7.0 million. That was actually worse than Q1 2024's negative $1.6 million. They blamed higher R&D and SG&A costs, linked to government funding delays and Pangiam integration. And the outlook for FY25 adjusted EBITDA, also negative. Single-digit millions negative.
Not great. And we already touched on the declining backlog.
Right, down to $385 million, end of Q1 25. That sequential decline is definitely a concern. So the big picture financially. Modest growth, but persistent significant losses. Costs seem to be running high relative to the profit they make on sales. There's no clear path to sustainable profit just yet.
Okay, let's look at the balance sheet then. What does their financial position look like? Assets, liabilities.
Well, cash position actually improved a lot recently. They had $107.6 million in cash and equivalents at the end of March 2025. That's way up from about $50 million at the end of 2024.
But how did they get that cash? Not from profits, we know that.
Oh, exactly. It came mainly from people exercising warrants, basically options to buy stock, and from their ATM offering, selling shares into the market.
So dilution. Raising cash by issuing more stock.
Precisely. They also managed to cut their long-term debt by about $58 million in Q1 25 by converting some notes into equity. Again, dilution. Total gross debt is around $143 million now. Net debt maybe $101 million. The one report suggested net debt improved significantly more, possibly using a different calculation method.
What else stands out on the balance sheet?
Working capital looks okay, current ratio at 1.66. Stockholders' equity actually flipped back to positive from negative at year-end, thanks to all those share issuances. But they still have a huge amount tied up in goodwill, 119 times YEM, and intangible assets, $189.
Leftovers from acquisitions like Pangiam.
Yep. And that carries a constant risk of more impairment charges if those assets don't perform as expected. Derivative liabilities decreased, which is good.
So key takeaway on the balance sheet. Better cash, less debt, but achieved through dilution, not profits. And that goodwill intangibles risk is still looming large.
You got it. That sums it up well.
What about cash flow? Where's the actual cash moving?
Operating cash flow, consistently negative. FY22, FY23, FY24, all cash out the door from operations. Q1 25 showed a bit of an improvement, only negative $6.7 million compared to negative $14.4 million the year before, but still negative.
Still burning cash, just running the business.
Right. Investing cash flow goes into CapEx and acquisitions. Financing cash flow, though, that's where the big positive numbers are. Lots of cash coming in from those warrant exercises and ATM offerings in Q1 25, 66 LMETs, and Q1 24, 51 FS.
Reinforces the point. They rely on financing to fund everything because operations aren't generating cash.
Exactly. And remember that report from April suggesting they might only have 4 or 5 quarters at best of cash runway?
Yeah.
That really underscores how urgently they need to turn that operating cash flow positive.
Okay, last bit on financials. Key ratios, valuation metrics, what do they tell us?
Well, profitability ratios are all negative, obviously. Liquidity looks okay with that current ratio near 1.7. Solvency, debt to equity is around 1.00. EPS is negative.
And valuation, how's the market pricing this?
Seems stretched. Forward price to sales is over 6x. EV revenue figures were mixed in reports, one calling it discounted at 10x, another saying 13x is not a bargain. Zacks value score is an F.
So, bottom line on valuation.
Well, it's pretty rich for a company losing money, with negative EBITDA, only modest growth, and these governance clouds hanging over it. The AI label might be giving it a boost, despite weak fundamentals. Definitely doesn't look like a clear margin of safety here for value folks.
One final financial point, R&D spending. Are they investing enough in the future?
They are spending more recently. R&D was over 12% of revenue in Q1 2025. They say they're focusing on SaaS evolution, new data sources, analytics, guidance capabilities.
Which is good. You need that.
Absolutely crucial. But that spending has to eventually translate into profitable products and market share gains. Given the ongoing losses, you do have to question how effective the R&D has been historically in generating returns.
Makes sense. Okay, let's move on to Chapter 4, market sentiment. What are the analysts saying? What's the vibe out there?
It's mixed, really. The overall consensus rating seems to lean towards buy, maybe around a 2.0 average score if 1 is strong buy and 5 is sell.
Okay, so generally positive, but not overwhelmingly so.
Right. And the price targets show that uncertainty. The average is somewhere between, say, $4.83 and $6.25. But the range is pretty wide, like $3.50 up to $6.
Yeah.
Cantor Fitzgerald, for example, recently trimmed their target to $5, but kept an overweight rating.
Have there been many recent changes or comments?
Yeah, a mix. Some downgrades or holds, but also some strong buy reiterations earlier in 2025. Analysts like the backlog in number, but they're definitely voicing concerns about the weak revenue growth, the downward revisions to guidance.
And the valuation.
Yeah, some notes mention the EV revenue multiple being maybe discounted, which could suggest confidence is shaky. Missing revenue expectations and the weak guidance definitely triggered some target cuts.
So no clear bullish consensus from analysts. And what about the stock price action itself?
Well, the fact that the stock is way down from its 52-week high, that tells you market sentiment has been pretty negative overall, likely driven by those governance issues and the financial performance we've been discussing. Analyst views might not be reflecting the full picture for, say, a cautious value investor.
Okay, Chapter 5. Ownership structure. Who actually owns BBAI? Insiders? Big institutions?
Insider ownership is quite low. We mentioned CEO McAleenan has less than 0.1%. Total insider ownership is only around 3%.
Not a lot of skin in the game from the inside team.
Not really. Institutionally, the big story was AE Industrial Partners, AEIP. They were the biggest holder, over 10%, being the private equity sponsor from this SPAC deal. Were. They sold a huge block of shares in April 2025, massively reduced their direct holdings, though they still have people on the board.
Wow. A key sponsor selling off a big chunk. That doesn't look great, does it?
It's definitely a concerning signal, especially coming after negative news. Other big holders include BlackRock, Vanguard, Millennium Management. Institutional ownership overall is reported somewhere between 7.5% and maybe 24%. The numbers vary a bit. Hedge fund presence seems low based on older data.
And we already talked about the recent insider sales by the CFO and CAO.
Right. CFO Peffer, CAO Ricker, and also Director Dorothy Hayes all sold shares in May 2025, plus that big AEIP affiliate sale in March-April.
So the key takeaway on ownership. The main PE sponsor drastically cut its stake, and key financial execs and a director sold recently too. Seems bearish.
Yeah, during a time of operational and governance challenges, those sales definitely send a potential signal about insider confidence or lack thereof.
Okay, let's pull together the potential downsides. Chapter 6, risk assessment. What are the big business and operational risks?
Number one has to be the dependence on government contracts. Budgets change, priorities shift, policies evolve, shutdowns happen. It's inherently risky.
And the lumpy revenue that comes with it.
Exactly. Plus, intense competition from big tech, defense giants, and specialized AI players. There are risks around executing contracts properly, scaling efficiently, controlling costs, especially with funding delays.
Customer concentration, too, like the Virgin Orbit example.
Yep. And don't forget the risks of integrating Pangiam smoothly. All these things kind of interweave to create a really challenging environment to operate in profitably.
Okay, what about the purely financial risks?
Persistent unprofitability is the big one. Net losses, negative adjusted EBITDA, leads directly to the next risk. Negative operating cash flow and relying on external financing.
Which means debt risk and dilution risk.
You got it. They have debt obligations, convertible notes that could dilute shareholders further. And they've already diluted heavily through warrant exercises and the ATM offering. Then there's that goodwill impairment risk we keep mentioning.
And the valuation concerns.
Right. Stretch multiples, that F-value score, it all adds up to a risk of getting stuck on that dilution treadmill, constantly needing to sell shares just to stay afloat if they can't turn profitable.
And the governance and legal risks seem pretty front and center, too.
Absolutely. Those shareholder lawsuits, they cost money, distract management, damage reputation, even if they settle. The material weakness in internal controls is a serious red flag, raises questions about financial reliability, attracts potential regulatory heat, and has to be fixed.
Free statements themselves just erode trust, don't they?
Completely. And all these governance issues can make it harder to raise capital, keep management focused, and maintain credibility, especially with those crucial government clients who demand reliability.
One specific risk mentioned was potential U.S. tariffs in 2025. How might that play out?
It's mostly indirect, probably. Tariffs on tech components could raise their hardware costs, maybe for digital identity sensors or stuff like that. Could also increase software or cloud costs if their providers are hit.
And maybe impact client budgets?
Potentially, yeah. Commercial clients might tighten belts if tariffs bite into the economy. BBAI might need supply chain tweaks. But the main hit is likely higher costs for underlying tech and maybe slower commercial demand. Less direct impact than, say, the government budget risks.
Okay, wrapping things up then. Chapter 7, brief conclusion. What's the essence of our findings on BigBear.ai?
Well, summarizing it all, BBAI is definitely playing in a high-growth sandbox, the decision intelligence market, huge potential there. Yeah. But they're facing some serious headwinds right now.
Especially governance and the financials.
Exactly. The governance issues, the lack of profitability, those are major hurdles. The new CEO, McAleenan, brings hope with his background, maybe a strategic reset. But the challenges are substantial and very real.
So from a value investing perspective, weighing everything we've discussed, what's the call?
Based on this deep dive into the reports, right now, BigBear.ai just doesn't look like an attractive proposition for a value investor. There are too many concerns.
Like the management integrity questions.
Yeah, the governance problems, the lack of a clear economic moat, that uncertain path to actually making money consistently.
And a valuation that doesn't really offer much cushion for error.
Right. No clear margin of safety. The risks, frankly, seem to outweigh the potential rewards at this particular moment based on the information available.
Okay. We've dug deep into the numbers, the strategy, the risks. But we wanted to leave you with one final thought, something maybe a bit provocative to chew on.
Yeah, think about this. BigBear.ai is deeply involved with government, defense, national security. We've seen the issues with their financial reporting, their internal controls. So the broader question is, what does this tell us about the need for transparency and accountability as AI gets more and more embedded in these critical national security functions?
It's a really important question, right? Goes beyond just whether BBAI is a good stock pick. It's about trust and oversight in a powerful, rapidly expanding technology field.
Definitely something worth considering.
So if you found this deep dive helpful, if you appreciate this kind of in-depth analysis, please do subscribe to the Stock Analytics AI YouTube channel. We'll have more deep dives coming your way.
And just the usual reminder, this discussion was purely for informational purposes. It is absolutely not financial advice. Investing, especially in AI companies, involves significant risks. Always do your own thorough research before making any decisions.
And we should mention, AI and data analysis tools were used to help us aggregate and process the information from all the source reports we discussed today.
That's right. Helps us cut through the noise, like you said earlier.